Wait a minute or two. Okay, welcome, folks. I hope you've had a chance to finish your quiz. By now, it's almost too late to get started because it's only an hour left of it. But today we're going to, continue with our discussion of real options. Before I start, are there any questions on? Because we have 5 more sessions left. We have the final exam, and we have the final project. The project is due on the 10th. And keep your eye out for a to-do list that will list out everything you need to get done on the project. I'll send it out to you probably tomorrow, so you'll have at least a sense of what you need to get done. No questions? Okay, so let's talk about options. Okay? We're going to start again with the test for today. So let's start with a very simple proposition. Let's assume you're a small startup. Right? Come up with a new cell phone technology that speeds up downloads, makes the interface much smoother. Based on what you know today, and that's key, you think it'll cost you about $2 billion to develop the technology. And you think based on what you know today that your expected cash flows from developing it today would be only $1.5 billion. So here's my first question. It's an easy one. Let's get it out of the way. Nick, would you develop the technology?
No, because like you
negative net present.
Yeah, exactly.
Negative net present value investment, right? So you're saying this is obvious. Why are we wasting our time on this? So Raja, I'm going to turn the focus back to you now. So this right now is a non-viable technology, but you work for an established cell phone manufacturer, looks at this technology, and right now you believe the same thing. It's not viable right now, but you get the exclusive rights to this technology for the next few years. Might you be willing to pay something for this technology? Raja, where are you? Oh,
yeah, I would say yes, because one, you might have potential synergies in the present, and in the long term, there might be a growth or option change of that expected value of the new technology.
In fact, even if you remove the synergies, you can see why you might pay for it, right? Right now, it's not viable, but things can change. The market can get bigger, the technology can shift, the cost can change. Today, we're going to talk about why companies might pay for non-viable technologies, non-viable licenses, and they do it all the time. You say, well, they're crazy. We're going to talk about an options argument, that you're effectively buying an option. And in fact, let's talk about that option. So let's say you decide you're going to pay for this non-viable technology. Right? I'm going to ask you a question about what's going to drive how much you pay. First, if I increase the number of years that I have the rights to this technology, would you pay more or less?
You would pay more because there's potentially more cash flows.
And you have more time for your hope to play out, right? Because right now the technology is not viable. If I gave you 15 years, maybe something will happen. Now comes the tricky part. What if the uncertainty you face about the future is much greater in this technology than in other technologies? Would that reduce the amount you pay or increase the amount you pay?
I think it would also increase because option prices are positively affected by uncertainty.
And intuitively, you can see why, right? For hope to play out, what has to happen? The future has to be uncertain. The future is certain and you're going to lose money. Why would you ever pay for something? So uncertainty becomes your ally, something we talked about in the context of options, how it upends everything we know about risk, right? Up till now, risk was always a bad thing, but in options, risk becomes your ally. So today we're going to focus on that because it is, I think, at the heart of many of the big debates you're having when you look at companies with big platforms. Right now, you might say, what am I going to do with this platform? And right now, there might be nothing you can do with that platform. but who knows what tomorrow will deliver. So I'm going to take you back to where we left off in the last session. We were talking about, the Black-Scholes option pricing model. It sounds incredibly abstract. So why are we wasting time on the Black-Scholes? Because we're going to use it to actually price real options. And I left you with one of the limitations of the Black-Scholes model. This is a conventional Black-Scholes model. One of the limitations I said of the conventional Black-Scholes model is you can only value options that are dividend protected. Why? Because I forgot to include dividends in the model. And I said, in the real world, we're going to have to deal with dividends. So what I'm going to do is take the traditional Black-Scholes model. So this is the traditional Black-Scholes and adapt it to a dividend paying underlying asset. And here are the two changes I'm going to make. First, if you want, you can compare this page to page 17 to see what's different about the dividend adjusted version. The first, instead of using the current stock price, which is what you use in the traditional Black-Scholes, you adjust the current stock price for the expected price changes that are going to happen when the company pays a dividend. Let me explain. Let's assume you have a stock that's trading at $100 right now. But this stock has a 1% dividend yield, 1% every year for the next 10 years. Roughly speaking, you know what happens when a stock pays a 1% dividend? The price drops by roughly 1%. So what I'm going to do is take the current stock price and reduce it by 1% a year. It looks like a present value factor, but what I'm doing is taking out the effects of those dividend price drops that are going to happen every year for the next 10 years. That $100 stock price is going to become like $93 or $94. I'm reducing the stock price for the expected drop in the price that will happen when the dividends get paid. That's the first adjustment. Here's the second one. In a traditional Black-Scholes, you borrow money to buy the stock, right? And when you borrow money, you got to pay the interest rate on that borrowing. That's why you have a riskless rate in the equation. So if you go back a couple of pages, you notice in the equation, there's an R. That's a riskless rate on your borrowing. But imagine borrowing money to buy a dividend paying stock, because that's what you do in the underlying portfolio. You're going to get a dividend yield on the stock, right? So if you have a 4% risk-free rate and your dividend yield is 1%, your net cost is going to be only 3%. Why? Because you can collect the dividends on the stock and use it to pay the risk. So if you look inside the equation, there's an R minus Y. Y is the dividend yield, R is the riskless rate. So by adjusting the stock price and the carrying cost, I've effectively taken the traditional Black-Scholes and made it into a model that I can use to value an asset that pays a dividend. This is the model you're going to see in most of the real options we're going to value. So if you're ever trying to replicate the value, you need 6 inputs: S, the current stock price; K, the strike price; R, the riskless rate; T, the life of the option; sigma, which is the standard deviation of value; and Y, which is the dividend yield on the stock. And if you give me those 6 inputs, I'm going to plug it into this equation, come up with D1 and D2, N of D1 and N of D2, and value the call option. And if you can value a call option, you can definitely value a put option. And here's why. If you have a call option and a put option with the same strike price and the same maturity, they're locked at the hip with what's called put-call parity. You're saying, what the heck is that? Basically, arbitrage requires that if I tell you that a call with the strike price of 40 and 3 months to expiration is trading at $3, the put has to be linked to that price, because if it wasn't, I could actually create a riskless position and make money. It's called put-call parity. And if I use put-call parity, I can take this call option equation and convert it into an equation to value a put. There are very few real options that are puts. There's one where we'll use this equation. In most of the others, we'll be using the call option valuation for the option. So that's basic option pricing. Now, if you open up any real options book, one of the problems with most real options books, and there are dozens and dozens out there, they're written by purists. Not only do they believe that everything is an option, but they want perfection when it comes to pricing. And early on in these books, they will tell you, you cannot use the Black-Scholes model to value real options. And we spent all this time on the Black-Scholes model. I disagree with them, but I'll give you the basis for why they say that. You remember what I said the Black-Scholes model was designed to value European or American options? Rodrigo, do you remember? What is the Black-Scholes model value?
Was it European options.
European options can be exercised only at maturity, right? Let's take a few real options. Let's suppose you have a patent and you have 17 years left on the patent. Now, if you want to be a successful business, do you want to develop the patent before you get to the end of the 17th year? Wait till the end of the 17th year. I would think you'd want to develop it sooner, right? Otherwise, you lose all that protection. So the essence of a real option is you are going to exercise early. Now, do you see why the purists don't like the Black-Scholes model? Their argument is the Black-Scholes model is designed to value European options. Real options get exercised early. Therefore, you should always use the binomial model because it allows for early exercise. True. But it's a nightmare to actually use because you got to draw these little branches and come up with values at every branch. So people who say you should always use the binomial never actually show you how to do it, especially with a 10-year patent. So you know what I'm going to do? I'm going to disagree with them. I'm going to use the Black-Scholes model, even though it's a European option pricing model to value a patent, to value undeveloped reserves. And I'm going to say, look, I know it's not right, but it's going to give you a floor value. Because remember, an American option should always trade at a premium on a European option because you get everything you get with a European option, plus the advantage of being able to exercise early. So you know what? I'll take my chances with the Black-Scholes because even though it might not be the perfect model for real options, it's much easier to use. So I will do it without any apologies to pure options people because I need to actually come up with a number, and the Black-Scholes gives me a way of coming up with that number. But having said all of this, option pricing is incredibly it's intimidating to people who, not even if they've taken a you could have taken a finance class, but option, I mean, think of this, you've got ND1 and ND2 and E minus K. I mean, you look at this and say, what the heck is this? So I'm very cautious about bringing real option pricing models into the arena because when you do it, you lose the intuition and you lose people. So I'm going to give you an alternative. If you have an options argument, you don't want to use Black-Scholes and binomial and all of that and replication and arbitrage, you can use decision trees. You know what decision trees are? They're a much simpler version of the binomial. First, you can have 3 branches, you attach probabilities. You do this in operations research and statistics classes. In fact, if you ask me, you don't use them enough in finance because if you do a decision tree right, and what does that require? It requires that you not only estimate what the branches are and the probabilities, but you also adjust the discount rates for different points in the tree, reflecting the risk in each part of the tree. You will actually get a value exactly equal to an option pricing model value without ever using an option pricing model. I'll tell you the place where decision trees work best. It's with young pharmaceutical companies. So if you want to value a drug for a pharmaceutical company, especially early in the process, when the research is being done in the drug, think of how many barriers you got to get through before the drug becomes a commercial product. You got 3 stages to the FDA approval process. At each stage, if you're denied or rejected, the game ends. And if you're approved, you go to the next stage and the next stage. And finally, if you get approved through all 3 stages, then you can, if you want to, go into commercial production. So it fits perfectly into a decision tree framework because the risks are discrete, right? At each stage, you either get approved or rejected, and you can draw every branch. So I'll give you an example of a decision tree that I drew for a diabetes drug being developed by a small pharmaceutical company. So this was a drug that was going to treat diabetes, but at the time the R&D was being done, they didn't know whether it would work, and if it did work, whether it would work on both type 1 and type 2 diabetes. So you're trying to value the drug very early in the process. So you're right here at the start of the decision tree. You're going to test, and if it looks like the test is successful, and there's a 70% chance of success and failure. If you succeed, then you follow up and say, is this good just for type 1, just for type 2, type 1 and 2. So the way to read a decision tree is whenever you see a round area, that's a probabilistic node where you can have success or failure. You've got to estimate probabilities. The squares are decision points where you get to decide, do I want to go forward or not? And at the end of the game, you go to the very end of the decision tree, you see the value of this drug can range anywhere from minus 366 million to 887 million, depending on which branch you end up doing. So the 887 million is you succeed at every stage, and it turns out to be a drug that is good for both type 1 and type 2 diabetes. So when you look at the difference in values, the value can be anywhere from minus 366 to 887. And you're trying to estimate whether you should develop the drug and how much it's worth. Since I've attached the probabilities at every branch, you can actually, it's called rolling back the tree. What you do is you take the expected value at every branch and you work backwards. The value that you get right now for developing the drug is 50.36 million. So you pay 50.36 million. It could be a huge hit and make you 887 million, or it could be a tremendous failure. And the worst failures are when you pass through every stage in the approval process and actually crash and burn at the last stage. Do you see why that's the worst? Because then you spend the money at each stage, you think it's going to be a blockbuster drug, and it blows up. So decision tree is actually a much more intuitive way of taking people through risks, especially if there are multi-stage risks. You've got to get through stage 1 to get to stage 2 to get to stage 3. So having said all of that, let me review again the 3 big questions we're going to ask with real options. So I'm going to present you with a bunch of real options. First question I'm going to ask is, how do I know there's an option here? What do you look at? I'm going to use payoff diagrams to illustrate that there's an option. If it looks like a call option, then I'm going to argue, let's call it an option. Let's try to value. Second question, is there exclusivity? Do I and I alone have the right to develop it? The more exclusivity you have, the greater the value of the option. And the third question is, can I use an option pricing model like the Black-Scholes or the binomial? And the answer to that depends on whether the underlying asset is traded and the option is traded. If they're both traded, you're getting very close to meeting every single requirement. So with every real option I present, I'm going to take you through these 3 questions at the end saying, hey, are we on solid ground using option pricing to value this real option? So let's get the show on the road. We're going to start by looking at options in projects and investments at companies. You remember your corporate finance class when you did capital budgeting? You did capital budgeting. What did you do? You took a project, you project out the expected cash flows, assuming the project is taken today. You estimated what the initial investment was, and you computed a net present value. And the rule was very straightforward, right? If the NPV is greater than 0, you take the project. If it's less than 0, you reject the project. Don't abandon that rule. It's a very solid rule. But what you're missing when you do that analysis, it's a static traditional capital budgeting analysis, is 3 possible options. Here's the first one. You can have a project which has a negative net present value today, but the rights to that project can still be valuable for the reasons we pointed out earlier, which is the project looks bad today, but things can change. The market can get bigger, the cost can shift, the option to delay. So a project is a bad project today, but because you get the right to wait, it could be worth more. So we're going to talk about the option to delay. And we're going to argue that when you value a patent or undeveloped reserves in an oil company, you have an option to delay. The second option is kind of fun. Normally, when you take a project, it's a negative net present value project. You're told don't take the project. But let's give this project a name. You're a US company and you are entering China for the first time, and you're making an investment in China. I can almost guarantee that that first investment you're going to make in China is going to have a negative net present value. Why? Because you're building up infrastructure, you're learning the market, and it could be so let's say you know you're going to get a negative net present value on the project. You walk in with open eyes. But you know why you might choose to still take that project? Because if that project works well, think of what it's opened up to you. A market of 1.2 billion people with immense potential, right? The option to expand might sometimes mean that you take a project with a negative net present value, but because it gives you an entree into the artificial intelligence market, into China, into electric cars, you might choose to take that initial investment. If you're Ford and you buy Nikola and you pay a premium, you say, why would you want to do that? You know why you might do that? Because it gives you an entree into an electric truck market that might be a huge market. That's your option to expand. In fact, when people talk about strategic investing, they're basically talking about options to expand, because they said this project is a bad project, we'd have to take it anyway. If they made their arguments correctly, they're making an argument for an option to expand. And there's a third option. You've got an option to delay, an option to expand. You've got an option to abandon. You know the option to abandon is? You take a big project, it's a 30-year project, but 3 years in, you know this project is never going to make it. It's turning out to be a terrible project. Now, if you're stuck with this project for the remaining 27 years, it's going to drain value from your company. If you had the right to walk away from this project, that right is worth a lot of money, right? Because you're cutting off your costs after 3 years. That's your option to abandon. And if you can build in that option to abandon, you might be more willing to take long-term projects than without that option. We're going to talk about putting numbers on these options. And what we're going to get at the end is this option will give you a way of paying a premium over your DCF, or even taking projects that look bad on a traditional DCF basis. So let's start with the option to delay. Put simply, here's what the option to delay looks like. You have a project. It's a bad project today. No debating. It's not a, so you feel, everybody looking, it's a bad project today. But I give you the exclusive rights to this project for the next 20 years. You might say, you know what? Even though the project is a bad project today, I'll pay something for the right. We can debate how much to pay, but you're paying for the rights to a bad project in the hope and the prayer that this project could become a good project. But you have exclusive rights. It's the exclusive rights that give you the value of the project. Remember, I promised you that whenever I talked about a real option, I would show you a payoff diagram. If I were to draw the payoff diagram in this option, here's what it would look like. You have the exclusive rights to take this project anytime you want to. If you decide to exercise that right, you will have to make the initial investment in the project, build the toll road, put up the factory, whatever that cost is. That becomes the equivalent of the strike price. Of course, you will do this only if the present value of the cash flows exceed the cost of putting up the project. Right now, that's not true. It's not viable, but sometime in the future, it might be true. But of course, if this never happens, what do you lose? You lose whatever you pay to get these exclusive rights. Could you have buyer's remorse from doing this? Absolutely. People get it all the time. They get the exclusive rights to doing something, and 20 years later, they said, I wish I hadn't done that. Doesn't make it a bad decision in hindsight, but that's the nature of options, is for every option that works out, there'll be 3 that you throw away. The option to delay is an incredibly useful option because it allows you to frame a couple of things that you might be asked to value in the form of options. Let's take a patent. A lot of technology companies, in fact, when you watch Shark Tank, after every person gets up there and describes what they're going to do, what's the first question they're asked? Have you patented it? What does a patent give you? It gives you protection from competition for the next 15, the next 17, the next 20 years, depending on the type of patent. Now, some things, the patent is much more powerful than others. So if you write software, for instance, much more difficult to patent software because you can patent the lines of code, but you can't patent the output. So if you have very effective software and somebody else comes up with software that looks just like yours, but they have different code, they haven't violated the patent. So when you have a patent, you have exclusive rights to convert this patent into a commercial product anytime over the next 17 years. So let's make this less abstract. Let's assume that the present value of the cash flows you would get from developing the patent today. So let's not even know what if in the future. If you develop the patent today, what do you get as cash flows? You project out the cash flows, you get the present value. That becomes the S in the model. That is the underlying asset. The cost of developing the patent is I. If V is greater than I, the present value of cash flows exceeds the cost, you will develop the patent, keep the difference. You have a positive net present value. But if V is less than I, what do? You sit on the patent and you wait and you hope that something will change. Of course, as I said, nothing might change, but something could change. You could have a non-viable patent become a viable one. So again, if you were thinking in terms of payoff diagrams, the cost of converting the patent into a product becomes the equivalent of the strike price. You will do it only if the present value of the cash flows from developing the patent to a product exceeds that cost. And if that never happens, what did you lose? How did you get this patent in the first place? What are some of the ways companies end up with patents? Angela, you want to try? How do companies end up with patents?
R&D expenses.
One is R&D, right? You can think of what you spend on R&D as the cost of acquiring an option. Or you could acquire patents. Google bought all of Qualcomm's patents. I think they bought a portfolio of like 300 patents for like $3 billion. You could acquire a patent and 20 years later look back and say, I wish I hadn't done that. You can spend R&D, you can acquire a patent. Andreas?
Does this also apply for the patents that expire? Like
all patents expire. All patents expire. No patent is forever. In fact, the law underlying patents, I think, depending on the product, gives you 20 years for some and 15 years for others. So all patents expire. And of course, a patent that has less time left on it is worth less than a patent with more time, right? It goes back to the point we made about, no, would you prefer to have 15 years to play the game of 5? I definitely would like to have 15 years. So it's an option with a ticking clock, because every year the option is going to get less valuable. So by the time you get to year 13, you're getting desperate. And by the time you get to year 15, you're close to giving up. It's not going to happen. So let's talk about valuing a patent as an option using an option pricing model. To use any option pricing model, what do I need? I need to get all of those inputs, S, K, R, T, sigma. So let's see if we can get those inputs for a patent as an option. Nick, you had a question?
Yeah, actually, so I guess that like to value the price that you're going to sell it with, essentially you have to, for example, do this maximization problem of solving for monopoly profits.
No, let's not even go there. Why do you assume you're a monopoly? A patent doesn't necessarily give you a monopoly, it just gives you a market. So don't put in any added layers. The monopoly basically means you're the only game in town. A patent just means that you have a better dish drainer. Not the only dish drainer in the world. So it might give you a pricing premium. Remember the Scrub Daddy, one of the big, you know, on Shark Tank's biggest, most successful products is this product called the Scrub Daddy. Have you ever seen the Scrub Daddy? When you look at it, you say, why didn't I think of this? Why did I go to school? It's like this little sponge. It's, you know, like it looks like any sponge, but it works incredibly well. They had a patent on the Scrub Daddy. That Scrub Daddy's generated like tens of millions of dollars in revenues every year. It's not the only scrubber in the game. It's a little better than other scrubbers, and they sell it at a premium price. In fact, getting on Shark Tank might increase the value of your patent 5-fold, right? Because getting on Shark Tank basically means people see you on TV. Next thing you know, you're getting a pricing premium and Mark Cuban's attached to your name. There's a reason I think this game plays out. But when we talk about present value cash flows, if it's a monopoly, of course, you might be able to charge a higher price. But even if it's not a monopoly, I'm asking you to make the best estimates of what you can make from developing Scrub Daddy into a commercial product for the next 12, 13, 15 years, whatever's left in the patent. That becomes the S in the model.
I see. Thanks.
So let's talk about how we would get these numbers for an actual patent. So let's say you're hired by Pfizer. And Pfizer has told you, your job is to value the patents we have in the pipeline. So remember, Pfizer patent, you're talking about a drug that is working its way through a pipeline to treat a disease. So let's pick a disease. Jake, do you have any particular favorite diseases you'd like to cure, other than COVID, of course?
Alzheimer's.
Okay, Alzheimer's. That's a great choice because, you know, so let's suppose you have a drug working its way through that'll perhaps not cure Alzheimer's, but reduce its damage to the brain. Tell me how you'd estimate. So if you develop, so let's assume that the drug, so even though the drug's not made its way all the way through, let's say it makes it through, and I ask you, can you estimate what the value of this drug developed is going to be? How would you go about doing it? You'd have to start with the number of people with Alzheimer's, right? So start with the percentage of the population that has Alzheimer's. This is actually a very, if you've never seen pharmaceutical companies work through it, it's an extraordinarily scary and morbid way of going through it. So let's say like 6% of the population, let's say 10% of the US population has Alzheimer's, 20 million people. Then they will estimate what percentage of the people with Alzheimer's go to a doctor. Guess what? It's not 100%. Then they take the percentage of people who go to a doctor who get the right diagnosis. And that's not 100% either. Then they get the percent of people who get the right diagnosis who can afford the medication. Definitely not 100%. And then you would take the percent of people who can afford the medication will actually take the medication, which means for every 100 people with Alzheimer's, you might estimate 2 people will take your drug. Then you will have to estimate a price for the drug based on what insurance companies, and there you look at what the competition is. If the next best drug is charging 15,000, you might say we charge 20,000 because we're better, and you come up with revenues and expense. The long story short, at the end of the process, you'll have cash flows from developing the drug. You discount those cash flows back at a cost of capital for a pharmaceutical company, and you come up with the present value. Traditional capital budgeting. If you can do that, you've just got the S in the model. That will now become the S in the option pricing model. But remember, to get an option valued, I need a variance in that S, right? And here's where things get messy. If this were a traditional option on a listed stock, I could look up the variance on the exchange. But this is an Alzheimer's drug. It's not traded. There's no variance. So you think, how the heck am I going to come up with a variance in that value? Remember Monte Carlo simulations? We did this in the context of valuation, where you said, look, I'm making an estimate of the number of people who have Alzheimer's, the number of people who go to a doctor. What if I allowed you to put distributions around each of those inputs? And he came up with not just one value for the drug, but a distribution of values. You know, one of the outputs from that distribution, you can tell me a standard deviation in your present value. That'll become the sigma in the model. But you know what? That's going to be a lot of work. You say, I'm lazy, or I don't know enough about the business to do that. I'll give you a shortcut. You might not like it. I'd say, you know what? Look at publicly traded pharmaceutical companies or biotechnology companies. Let's say the standard deviation is 30%, and then make a leap of faith to say, if those stock prices have a standard deviation 30%, that must roughly reflect the standard deviation of the project cash flows. And I'm going to, it's a leap of faith, but think of how much time it will save you. So you can either do a Monte Carlo simulation on your capital budgeting to come up with the standard deviation, or look up the standard deviation of publicly traded stocks in that space. That gives you sigma. So you got S, you got sigma. Then I ask you, what's the strike price? What does exercising this option mean? That you actually decide to convert this patent into a drug. You got to build factories, you got to hire salespeople. The cost of developing the drug becomes the strike price. So you got S, you got K, you got sigma. What's the life of this option? You patent the drug already, right? If it's working its way through the pipeline, I ask you, how many years are left in your patent? This goes back to Andreas's question. If you have 16 years left in the patent, I'm feeling pretty good. But if you have 6, I know the clock is ticking on me. So the remaining life of the patent, so it's the remaining life that matters, becomes the T in the option. So I've got SK, sigma, and T. The riskless rate is easy. It's whatever T-bond rate matches up to my, so my option is 6 years left in it. I take the 6-year riskless rate. So that was easy. But now I'm going to introduce the equivalent of a dividend yield. And let me tell you why I'm going to do this. If I left it with just this and I said there's no dividend yield, you know what you're going to do? You're going to end up not developing this drug to the very last day of the 17th year, because no option ever gets exercised before expiration, right? There's a time premium. So I've got to introduce a cost in here that forces you to exercise early, because that's what you do in real options. You develop the drug. And you know what that cost is? Let's say the drug becomes viable in year 2 and you have 15 years left on the option, on the patent. Part of you says, let's wait a year, let's collect more information, we'll learn more about it. That's good, right? Waiting, no, that's you learn the drug better. But what do you lose by waiting a year? You lose one of the remaining 15 years of protection you have. So every year you wait, I'm saying you're giving up something by waiting. that becomes the equivalent of the dividend yield. It's called the cost to delay. In this case, I'm going to keep it simple. If you have 16 years left in the patent, if you wait an extra year, you're going to give up 1/16 of your cash flows. I have S, K, R, T, and sigma. I plug those into the Black-Scholes model, and I have a value for the F. So I'm going to try this on a drug. And to do this, I'm going to go back about 20 years. And the reason I'm going to have to go back 20 years is I was on this drug able to get my hands on a cash flow projections made by the company that developed the drug. It's a drug called Avonex, drug to treat MS. And the company that came up with it is a company called Biogen. It's still around. It's now a much larger company. At that time, it was a young company that come up with Avonex, and they viewed it as a potential blockbuster drug. Blockbuster is just a generic term for any drug that's going to create billions of dollars in revenues rather than hundreds of millions. So what Biogen had done is they project a number of people with MS, gone through the process we just described, come up with cash flows. And the present value of the cash flows they came up with, using a cost, biotechnology company cost of capital, was 3,422 million, or 3.422 billion. That's the present value of developing the drug right now. They haven't done it yet, but say if we develop it now, that's what the present value of the cash flows will be. Now, they estimated that they decided to develop Avonex as a drug, it would cost them 2.875 billion right now to do the development. Why? Because they had never manufactured a drug before. They didn't have a sales force. They had to start from scratch. And the cost of doing this would be 2.875 billion. If I stopped right there and asked you what the net present value of this project is, you know what the answer is going to be? The difference between the 3,422, 2,875 is 547 million. That is the NPV of this project. If this were capital budgeting, we're done. Positive net present value is 547 million. But we're going to build on this. Given that they haven't developed the drug yet, there's still optionality. They can choose to wait. For how long? They have 17 years left on the patent. That's not the original patent life. This is the 17 years left on the patent. The riskless rate was about 6.7%. That was the 17-year T-bond rate. And this is a very, very unstable and uncertain business. In fact, the standard deviation the variance, the industry average variance for biotech firms at the time that I did this, these are publicly traded biotech firms, was 0.224. So I took the easy way out. I didn't do a Monte Carlo simulation. I'm going to take that as my variance in the value of S. And finally, this is a viable option. They can develop the drug today. If they choose to wait, which they can, what will they give up? They'll give up 1/17 because they have 17 years of protection. They'll give up one of those 17 years of protection. I plug the numbers in D1, D2, N of D1, N of D2. The value that I get for Avonex as an option is $907 million. What is the NPV? 547 million, right? You're saying, where's the extra 360 million in value coming from? This is the magic of options. You know why there's an extra 360 million? Because I'm uncertain about the future. And the more uncertain I get, the bigger that premium is going to get. But if you have MS, there's actually some bad news embedded in what I've just calculated. If they develop this drug today, the value of the drug goes to 547 million. If they choose to wait, it's worth 907 million. So what do you think they're going to do? They're going to wait. In fact, here's the scary thought. If there are no competitors, and this is key, no competitors on the horizon, and they're the only game in town, it turns out that they will wait about 8 to 9 years to actually develop the drug because the drug is worth more as an option than as a developed drug. So you'll be sitting there with MS thinking there's this great drug working its way through. It won't come, it won't come, it won't come. Why? Because for the company's perspective, it's better to wait than to develop. With US pharma companies, this almost never happens. And here's why. Biogen, while it was working on Avonex, also knew that Merck and Pfizer were working on their own drugs to treat MS. They thought they didn't have a 17-year window. They had a 4 to 5 year window because before Merck's drug came into the market. You know what it'll make my cost to delay? It's not 1/17th, it's 1/4 or 1/5. And you put that cost to delay in, the option value drops very quickly below my DCF value or my net present value, which means I'm going to develop the drug right away. But if you're a monopoly pharmaceutical company, you see what the consequences are, right? Drugs will come out much more slowly than in a competitive pharmaceutical business because you're going to wait a lot longer. There's optionality here. Now, if you ask me to value Biogen as a company, not just Avonex, but I could actually use one way I can value Biogen as a company is I can take traditional DCF and I can give them a much higher growth rate because of this blockbuster drug coming through and come up with the present value. That's always an option. But here's another way in which I can approach valuing Biogen. I can value it in 3 slices. The first slice would be the value of Avonex. That was the only patent they had that they had developed. I valued it as an option. But here are the other 2 slices. Biogen also had a couple of other drugs that they'd already developed that were commercially being sold, but they'd licensed them out to other pharmaceutical companies. I can calculate the values of those licensed revenues, right? Because I know what they are. So I'm going to do that. And that's going to be relatively simple. There were 2 other drugs they developed. One was my license out to Merck, the other to Upjohn. I knew what the licensing revenues were. I'm going to calculate the value of those revenues. But here's the tougher part. Biogen also has an R&D department that is ongoing. You know why that matters, right? That R&D department will produce patents. I don't know what patents they will produce or when they will produce them, but there'll be patents that will come out in the future. And I have to figure out what the value added is of that R&D department. I could take a very cynical view and say R&D departments are 0 excess returns and ignore them. But that's a pretty dangerous assumption, especially with biotechnology and pharmaceutical companies. So I'm going to try to value Biogen in 3 slices. Existing drugs, the patents they own, which in this case, just Avonex, and then the value of continuing R&D. Let's start with the existing drugs. There are 2 drugs, one to treat hepatitis B and another drug called Intron that they had produced, that they created, but they didn't produce. They actually licensed it out to other pharmaceutical companies. Now, normally when you license out a product to another company, there are 2 ways you can set up the license. One is you can set it up as a fixed fee, which means the company pays you 50 million, 30 million every year for the next 10 years. And the only risk you then run is that that company defaults on this contractual payment, which is like a debt risk, right? Cost debt risk. The other way you can set up a license is a percentage of revenues. You see the difference between the 2? When you set it up as a percent of revenues, you're basically exposing yourself to the operating risk that that company will face. You might have higher expected cash flows, but the discount rate you would then apply would be the cost of capital that reflects that higher risk. So first thing I noticed when I saw those 2 licenses, I wanted to see how the licenses were set out. And for Biogen, the 2 drugs they were producing in 97, they were on fixed licenses, and the amount they were collecting on these licenses were $50 million and expected to be that for the next 12 years. So they're going to get $50 million a year for the next 12 years. To value this, what do I need? I need a discount rate. So let's go to discounting 101. Your Biogen, you've licensed, let's say you've licensed both drugs to Merck. Merck has promised you $50 million a year for the next 12 years. It's contracted to pay you. You know what discount rate you should use on that $50 million to get the present value? It shouldn't be a cost of capital because you have no operating risk. It's a fixed license fee. It's a default risk, right? And whose default do you worry about? Not Biogen's default risk, but Merck's default risk. So you know what I ended up doing? I took the $50 million in licensing fees and discounted them back at the pre-tax cost of debt. Why pre-tax? Because the licensing fees are pre-tax cash flows. Pre-tax cost of debt of Merck of 7%. And what I got as a present value was $397 million. That's the value of the existing licenses that have been, drugs that have been licensed out. So I'd like you to ask what if questions. What if they license this out as 5% of revenues instead of $50 million a year? How would I value the license differently? Then you'd have to project out revenues, take 5% of the revenues, discount them back at a cost of capital, because now you're exposed to operating risk. Keep that as a general principle. Whenever you're asking what discount rate should I use in the cash flows, don't look at who's receiving the cash flows. Look at the risk in the cash flows. Get a discount rate that better reflects that risk. Now, with future R&D, I had to make some assumptions, and it wasn't easy to do it. So I'm not going to act as if this was, I could blow through it. Here's the problem with R&D. You spend money on R&D. What determines whether that R&D is going to pay off? The patents that come out of it and the drugs, and you don't know what they will do. Now, here's what I did know. I knew how much Biogen was spending on R&D. It was spending about $100 million in the most recent year. And they were planning to spend 20% more a year for the next 10 years. So 120 million, 144 million. So basically, they were going to spend a lot of money on R&D. Now, the question I had to ask was, is this R&D value creating, value destroying, or value neutral? How do we make that judgment? What kind of return on capital do I make on R&D relative to the cost of capital, right? If I make roughly the cost of capital, then I can completely ignore this third slice because whatever I put into R&D, I will get back in cash flows. There's no net value created. If you look at the biotechnology business collectively, they earn about 4 to 5% above the cost of capital. That's the power that those patents give you, protection from competition. I assume that Biogen would make about 4 to 5% above the cost of capital. What does that translate into? Every dollar they spend on R&D creates about $1.25 in value. It's value creating, and every dollar invested creates $1.25 in value. Am I sure about this? Of course not. There's a lot of uncertainty. And I'm going to use a discount rate of 15% on this third component because I'm very uncertain about the future. So actually, there are 3 different discount rates floating around in this valuation. For the licensing fees, I've used the 7% pre-tax cost of debt that Merck has. For the option, I basically use the cost of capital for Biogen to do the present value of the cash flows to get the S. But now for this R&D, I'm using the collective cost of capital of very young biotech companies to capture the risk in R&D. But here's how I'm going to end up valuing R&D. First, I forecast out how much money Biogen would spend on R&D because that's the only number that they kind of gave me an indication on. So 100 million growing at 20%. Then I asked how much value do I create from that? And remember, the assumption I made is every dollar of R&D creates $1.25 in value, which means 120 million I create in R&D in year 1 is going to create 150 million value. You're saying, how do you know? I don't. That's my estimate. In fact, if you take the difference, 150 minus 120, that's 30 million in excess value in year 1. And I do that for every year. You say, what happens after year 10? After year 10, I'm going to assume that R&D is going to become a neutral investment. It earns its cost of capital. And what this allows me to do is take the present value, the value created over the next 10 years, and I come up with 318.3 million. That's the value of my ongoing R&D. Let's see what we get for Biogen as a company. 3 slices. First slice is the drugs they've already licensed out to Merck. That's worth 397.13 million. The second slice is that Avonex patent, which we valued at 907 million. The third slice is future R&D, which we valued at 318 million. You add those 3 numbers up, you get a value of 1,622. This is the number you'd have come up with if you'd taken the free cash flow to the firm, discount the cost of capital and DCF. This is just a different way of getting there by slicing the company into its different pieces. There was almost no debt and no cash here, so I could just divide by the number of shares. The value per share that I got was $35.70. Don't try this on a Merck or Pfizer or an Upjohn. You go crazy. You know why? Think of how many patents they have. You'd be valuing 50 different patents. And you'd have to do project. It's not worth the effort for a big pharmaceutical company. But if you're doing a small pharmaceutical company with a single drug or 2 drugs working its way through the pipeline and 1 big patent, this may be an effective way of breaking down that value and saying, where's the value of this company coming from? Because for very young pharma companies, it might be 1 drug. You're not buying a company, you're buying a drug, a share of a drug, and how that drug will work out in the future. So you can see how patents, licenses might be options, but let's put them through the test. First, is there an option? Clearly, there's that payoff diagram, there's a kink around the exercise price. Clearly, it passes the test. And the contingency is you convert the patent into a drug only if the value of the cash flows exceeds the cost of developing the patent. Is there exclusivity? with a patent? It depends on how well the law is enforced, right? In some parts of the world, you can have a patent, you come to me and say, what's the value of this patent? I'm going to say nothing. You know why? Because somebody copies you, there's not a thing you can do. The value of a patent comes from the power of the legal system to enforce your ownership rights. In the US, yeah, there is exclusivity. And it's because you have patent courts that back up your patent. You can sue somebody and say, you got to pay me, you've violated my patent. Can I use an option pricing model? I'm on very dangerous ground. And do you see why? What are the requirements for an option pricing model to work well? You got to be able to trade the underlying asset. You got to be able to trade the option. What was the underlying asset with Avonex? The drug that you would sell to people with MS. I can't trade that. There's no market for it. I can't go to Bloomberg and say, buy me 1,000 shares of Avonex. I can't trade the patent. It's owned by a company. I have no idea how to buy or sell it. I'm on very dangerous ground. Doesn't mean I will not use, I did use Black-Scholes option pricing to come up with 907 million. But if you held a gun to my head and said, would you pay $907 million for Avonex as a patent? I'm going to hem and haw and say, maybe I'll pay 600 million, maybe I'll pay 650 because it's not easily monetized. And that's the way to think about those real options. You cannot really apply an option pricing model. It's not that you cannot come up with a number, but you're going to discount that number for the fact that you're not meeting the requirements for option pricing, replication, or arbitrage. Any questions about patents, licenses? So if I gave you an exclusive license to serve beer at the New York at Yankee Stadium, it's an option, right? You get exclusivity unless people sneak in beer, which I don't think they can that easily. And you can value that exclusivity. And guess why you need to value it? Because you don't get this license for free. I ask you to pay for it and decide how much to pay for it. You got to build in the fact that you can charge $10 a bottle in Yankee Stadium and get away with it because you have no competition. And by the time you get to the fifth inning, people are desperate for whatever. You can apply it, but remember, there's a grain of salt there, which is be careful about the option pricing models because they might not quite fit. Let's talk about a second option to delay. You're an oil company. You got developed reserves. You know what developed reserves are? These are the reserves you've developed. The rigs, oil's coming out of the ground. They sell the oil, you get the cash flows. But you also have undeveloped reserves, which means you have the right to develop the reserves, but you can choose not to develop them. March of 2020, do you remember what the oil price was? The peak of the COVID crisis, it dropped to $25 a barrel. It was estimated that 75% to 80% of the oil on the face of the earth had just become non-viable. Because shale oil, for instance, costs you $45 a barrel to get the oil out of the ground. $25, you're definitely not breaking even. But let's say you have rights to all these reserves, even though the oil price is 25. You know why those rights may still be valuable? Those undeveloped reserves, you might still pay because you know that oil price is not going to stay at 25. You know, oil prices are now 65. If you'd been able to buy reserves and people had sold them to you saying oil is worthless, take the reserve for free, think of how happy you're going to be now. When you have undeveloped reserves, here's the way the option works out. The cost of developing these reserves, let's call it X. The value of the oil under the ground becomes V. If V is greater than X, you will develop the reserve and produce the oil. But if V is less than X, what are you going to do? You're going to sit on that reserve and hope and pray that something changes. And what's that something? Oil prices go up. So if I were to draw this as a payoff diagram, here's what it'll look like. The cost of developing the reserve becomes the strike price. The value of the oil under the ground becomes the equivalent of the stock price. If the value of oil exceeds the cost, you'll develop the reserve, get the oil out, sell it. But if that never happens, what did you lose? Whatever you spend to get these reserves. And there are three ways you get reserves. First is you do exploration. All that money you spent might be wasted. The second is you buy the reserves from another company. And the third is you bid for reserves at a government auction. Many governments put their oil reserves up for auctions in different oil companies, but the money you spend to get those reserves becomes equivalent to the cost of the option. So let's think about how, if you're an oil company with undeveloped reserves, how you get the inputs, SKR. Again, I'm going to be very pragmatic because I want those 6 inputs to value an option. Let's see how we'd get those inputs for an undeveloped oil reserve. See, an oil company, you have these undeveloped reserves. I come and ask you, well, what's the value of the oil under the ground? If you decide to develop this reserve today, how much would you make? So to answer that question, what do you need? You need a rough estimate of how much oil is under the ground, but that's why you hire these geologists who tap rocks and say 50 million barrels. So you'd have to estimate how much you have in reserves. And what's the other thing that goes into what the value of that reserve is? It's the oil price. You take the reserves and you take the oil price, you give me an estimate. You said that's the value of the oil under the ground. That becomes the S in your model. The cost of developing the reserve will depend on where in the world this reserve is. If this reserve is in Saudi Arabia, you stick your finger in the sand, oil comes out, $3 a barrel, you can get the oil out, right? But if this reserve is in Canada, it might mean digging 5,000 feet, getting frozen oil out, trying to unfreeze it. The cost of developing reserve, depending on where it is, you have pretty good history. You can tell me, in the Gulf of Mexico, this is the cost. In the North Sea, this is the cost. In Saudi Arabia, this is the cost. In Canada, that becomes the cost of developing the reserve, the K. So I've got S, I've got K. In most cases, when you look at reserves as an oil company, you don't get those reserves in perpetuity. You get them for a finite period, after which they revert back to the government. So for instance, if the reserves are in the Gulf of Mexico and you bid for those reserves, and the Mexican government says you have 15 years to develop the reserves. At the end of 15 years, the reserves revert back to the Mexican government. That becomes the life of the option, is the period that you have the rights to this reserve. So I've got SKT. And then I need a sigma, right? The standard deviation. And here my life got a little simpler because unlike Avonex, where the Avonex is not traded, what's the underlying asset? It's oil. Oil is traded. I can look up the price. I can look up the volatility. I can look up the variance. It's more like a stock than a real option. I can get a sigma. So I've got SK, T, and sigma. My riskless rate, of course, matches up to my life. So that's easy. And here again, a couple of pragmatic things to factor in. One is, if you decide to develop an oil reserve, now, if you decide to exercise a call option on a stock, you get online or you call your broker, you exercise the option. 2 minutes later, you've exercised the option, right? But let's say oil prices go to $100 a barrel next week. And ExxonMobil decides to develop its undeveloped reserves. So guy at ExxonMobil picks up the phone and he calls, says, develop the reserves. Is oil going to come out of the ground the next day? Well, they've got to go, get the rigs in. And if you're lucky, maybe 2 years from now, oil will come out of the ground. You're saying, so what? Why did you decide to exercise these options? Because oil prices went to $100 a barrel, right? 2 years later, oil comes out of the ground. What might have happened that could give you a nightmare scenario? Oil prices will be back to $25 a barrel. It's called a development lag. There are ways you can protect yourself partially with futures and forwards, but only partially. So if you give me those inputs, I should be able to value undeveloped reserves. And I'm going to use that insight to value undeveloped reserves at an oil company called Gulf Oil, which was targeted for a hostile acquisition in the early 1980s. Now, one reason it was targeted is that a lot of undeveloped reserves, there are almost 3.038 billion barrels of undeveloped reserves. And it was estimated it would cost about $10 a barrel to develop the reserves. So it's 30.38 billion, they could develop all these reserves. You think, should they do it? Well, there's a lot of oil under the ground, and was estimated at that time oil prices were $22.38, and the variable cost would be about $7. So they'd make about $15.38 a barrel if they developed the reserves. However, it would take about 2 years for them to do the development. So you got to factor that in. You got to wait 2 years before the cash flows come out. And then about 12 years left on these reserves. That's the remaining life of these reserves. The T-bond rate was about 9%. Now here again, I'm going to introduce a cost of delay, which is if these reserves are viable as an oil company, part of you says, let's wait, maybe oil prices will go up. But when you wait, you give up the cash flows that you would have got by developing the reserve. That again is like it's essentially the equivalent of a dividend yield. It's a cost to delay. So here's what I tried to do. I decided to value the undeveloped reserves as options. And again, it's very simple. I'm going to follow the same rubric every time I do this. I'm going to ask, if I develop these reserves today, what would I get as cash flows? Well, I get 3,038 million barrels. I make $15.38 a barrel because that's the current oil price. I give up 2 years of cash flows. So that's what this 1 point, because that development lag, I get a present value of 42.38. If I develop the reserves today, the value of the oil under the ground is 42.38 billion. The cost of developing the reserve is 30.38 billion. If I stopped right there and say, what's the discounted cash flow value, the DCF value of the undeveloped reserves? The answer is the difference between the two, $12 billion. File that away, because I'm now going to value it as an option because I haven't developed the reserves yet. They have 12 years left. The variance in oil prices is 0.03. So the oil prices go up and down, and I'm capturing in the variance. The riskless rate is 9%. And each year that they delay developing the reserve, they give up that 5% cash flow they could have got. That becomes like a dividend yield. D1, D2, N of D1, N of D2. Remember when I described N of D1 and N of D2, I said it's a number between 0 and 1 you're going to get. It looks like a probability. It actually goes beyond looking like a probability. N of D2 is often described as the risk-neutral probability that S will be greater than K. So when you use a Black-Scholes option pricing model and you get N of D2 of 85.4%, I'm saying there's an 85.4% chance that this reserve will become viable and actually get developed, which shouldn't be surprising. It's already viable. So I'm getting a very high percentage. But here's the magic of options. If I value these undeveloped reserves as an option, the value that I get with the Black-Scholes model is 13.3 billion. Remember what the DCF value was? It was 12 billion. You're saying, where's the extra 1.3 billion coming from? It's magical. You know where it's coming from? It's coming from the fact that oil prices are volatile. If you made this variance 0, you know what will happen to this value? It'll go to 12 billion. All of the premium comes from the uncertainty you face about future oil prices. You value a company like Petrobras. Petrobras, about 65% of its value is in the form of undeveloped reserves. Why are they undeveloped? Because right now it's not viable to develop many of these reserves. They looked viable 10 years ago. When oil prices were 100, they're not viable today. But it would be a mistake to act like they're never going to be viable. There is an optionality here. And as oil prices get more volatile, those options can still have significant value. In fact, for Gulf Oil, I completed the valuation by bringing the developed reserves. The undeveloped reserves are worth 13.3 billion. So what's the value of the developed reserves? The developed reserves, they were generating about $915 million in cash flows every year. And if they kept developing these reserves, there are about 10 years of oil left in these reserves. So if they did nothing but continue developing those developed reserves, they'd get $915 million every year for the next 10 years on an expected cash flow basis. The cost of capital for an oil company is about 12.5% when I did this. Present value of $915 million at 12.5% is $5.07 billion. So as with Biogen, if you ask me to value an oil company, I can take developed reserves, value them with a discounted cash flow model, take the undeveloped reserves, value them as an option, add the two numbers up and come up with the value of the entire oil company. Take a company like ExxonMobil, but 85 to 90% of its value comes from developed reserves, but 10% of its value comes from undeveloped reserves. You take a company like Petrobras, about 40% of its value comes from developed reserves, 60% comes from undeveloped reserves. Petrobras has more optionality than ExxonMobil does. Doesn't make it a better company or a worse company, but there is that optionality, which means that when you do a DCF, you've got to be careful with these companies, because just taking the DCF value, you're probably undervaluing the company. Any questions about undeveloped reserves? Talk about the option to expand and why it's so exciting to people. An option to expand, it's not one project, but two projects. The first project has a negative net present value. You know it going in that you're going to lose money. You're saying, why would I do it? Because if you take the first project, it gives you the right to take a second project, which could be incredibly lucrative. Why? Because you're entering a big market. It's China, it's artificial intelligence, it's electric cars. It's a second project. That's the option. In fact, let's frame the option. The money you would spend to expand that second project becomes the equivalent of the strike price. If the value of the cash flows from expansion exceed that cost, you will expand and make the difference. If not, what do you lose? Remember the first project you took had a negative net present value? That's the price you pay for this option. So you buy an AI company, you pay way more than what that company is worth. You hope and pray that if things work out, you could then get into the AI market, which is a big market. And if it doesn't happen, you know what you write off? You write off the initial acquisition cost of the AI company. That's the cost of the option. So let's try this. So a few years ago, I was valuing an antivirus software company. So I did it the traditional way, right? Revenue growth, margins. Same. In fact, I used the same spreadsheet you guys are using to value your companies. Came up with a value of 115 million. But here's the piece of the company that I did not value. This company, as it acquired customers for its viral software, was building up a database. You're saying, so what? This database, it's like a platform, could be used to produce a database software. And right now, if you ask them, would you do it? Their answer is no, because right now it would cost them about $500 million to develop the software. And based on what they know now about this business, the expected cash flow is only 40 million a year for the next 10 years. And even without discounting, you can see that doesn't look very good. But they have the option to develop the database software. And the one thing they have going for them is it's an incredibly risky business. The standard deviation in cash flows in this business, because everything is changing so quickly, is 50%. So the discounted cash flow value of the company is 115 million, but there's a platform that can do other things that right now is not viable. But let's value the platform as an option. If you take the present value of 40 million a year for 10 years at 12%, the present value that you get is 226 million. Well below the 500 million they will have to spend to develop the software. So right now they wouldn't do it. But there's a lot of uncertainty, 50% standard deviation, 5 years to play the game. If I value this product, which is deep out of the money now, not viable, the value that I get for it as an option is 56. It's almost mind-blowing that a terrible project with a lot of risk actually brings this much to the table. I mean, you're saying, when would I ever run into this? I'll give you a personal example of when this came into play. 3 years ago, remember the Cambridge Analytica scandal, the privacy scandal that brought down Facebook? For a few weeks, Facebook's stock price was, and everybody was selling Facebook. They were convinced that this was going to put the company under. Its stock had dropped about 130. I did a traditional discounted cash flow valuation of Facebook. What did I do? I valued Facebook based on what I saw as its core business, which is online advertising. It's 98% online advertising, maybe even 100%. I came up with a value of about $135 per share. Stock price is 130. The value I'm getting is 135. I bought the shares. And when I bought the shares, people said, how come you're not giving a margin of safety? This is a very risky company. And I said, my response was, you're missing the point. In this case, I'm getting the online advertising business that Facebook has for $135 per share. But here's what I've not built into the number yet. They have 2.5 billion users, an incredibly intense platform. Right now, they haven't figured out how to make other money in other ways, retailing, entertainment. But if they ever figure that out, you know what you have? You have an incredibly valuable option. The reason I continue to hold Facebook at today's stock price is I don't think we've seen the end game for Facebook. Right now, they are making their money primarily from online advertising. But when you have 2.5 billion spending an hour a day in your ecosystem, you got an option there. I might not be able to put a number on that option, but here's what I know. That's a very valuable option because you have exclusivity and there's going to be value that comes out of it. So even if you never, ever actually value this option to expand, it is going to come into play when you make decisions on, should I buy Netflix? Should I buy Facebook? I mean, these companies have platforms that run into the hundreds of millions of people. And if they can, I mean, look at how well Amazon has used Amazon Prime as a platform to kind of create all these other things. That's what the option to expand is, that premium you're willing to pay over the discounted cash flow valuation. Because there are other things this company can do, but you can't think of what they are right now, but you're willing to pay that premium. Just a note of caution though, just because you have a big market, don't pay a premium. There's got to be some degree of exclusivity. The exclusivity might either come from legal protection from competition, which is what a patent gives you, or it could come from attachment to a platform from which, so the more intense a platform is, and that's why I would value Facebook's platform a lot more than Twitter's platform. A typical Twitter user stays on the platform 2 to 3 minutes. A typical Facebook user spends 45 minutes, an hour and 15 minutes. There's your value of option right there. An hour and 15 minutes, I can figure out more things to do with you than if you spend 3 minutes in my platform. So let's see if this option to expand meets our test. Is there an option? Yeah. There's a contingency. You will expand only if the present value of the cash flows exceeded. Is there exclusivity? It depends. If you and only you have the right to expand into the rest of China, I'm going to pay a huge amount for that option, even though your initial investment is not going to look good. But if everybody can do it, what's the value? And can I use an option pricing model? Again, I'm on dangerous ground because the underlying asset is not traded. In this case, the database software is not traded. The option is not traded. It's not going to stop me from using an option pricing model. But you know what? My investment in Facebook didn't come from a numerical calculation. It was from a reflection of the view that the option is worth a lot of money. We can debate whether it's worth 50 billion, 80 billion, or 100 billion. But it's coming from almost an informal assessment of how big is the market? What is this exclusivity that I'm getting with it? So I'm going to stop there, and when we start up on Wednesday, we're going to complete our real options discussion. But if you get a chance, review what we did today about patents and undeveloped reserves and the option to expand, because it's really, it's really fascinating when you start to peel the layers off as to where the value is coming from, because it'll give you some insight into why people are willing to pay the prices that they are for these big technology companies. This is the big deal, right? Big platforms. And my worry is that they're not being very discriminating about asking which of these platforms is worth more than which ones. And because not all platforms are worth money. The exclusivity is not there. So I will see you on Wednesday.
Professor, can I ask a quick question?
Sure.
Because you said about the whole thing with like the bad news with Facebook, right? That you bought because you valued because the fundamentals were there. However, and that reminded me, I think, of a diagram you have in your book where you, for example, you have this good news and that you have different distributions of how like you can react to good news, right? Is there like a diagram for the opposite?
Same thing, right? The bad news, if markets are rational, it says the bad news because bad news should lower your value.
Yeah.
So it's not that the price dropped that drew me to Facebook. I felt it dropped too much. Right? That's really what it is. So it's not just, so you got to revalue the company, and then you got to look at the price. Facebook went from being slightly overvalued before the news hit to slightly undervalued after. It actually went from significantly overvalued to slightly undervalued. Why? Because my value dropped, but the price dropped even more. So that's why you do the valuations. It's a dynamic process. Value versus price before, value versus price after. If the market is rational, guess what? Both will drop by the same amount. And you're going to say, look, it was fairly valued before, fairly valued now. I'm going to walk away. So you can draw a same graph because you got to bring in the market effect into the analysis as well.
Okay. Yeah. Thank you, Professor.
Alex?
Yes, I just have a quick question. If you could, by any chance, explain, I guess, where you got that or how you calculated that $1.25 of expected revenue per.
So here's how you can do it, right? Take $1, invest it at 12%, and your cost of capital is 9%. Just treat it as a perpetuity, right? If you take $12, so let's say you have $1 making 12 cents a year, and your cost of capital is 9%. What's the present value of 12 cents a year at a 9% cost of capital forever? It works out to be about $1.33. which means it's a 33%. So basically, if you can tell me what you earn as a return on capital and what your cost of capital is, I can convert that into a dollar value by saying, if I invested $1 at this cost of capital and you earn 3% more than that cost of capital, how much will that translate into? So $1.25 works out about a 3% excess return. If you earn about 3% above your cost of capital, a dollar invested would create about $1.25 in value. Very
Got it.
simplistically based on forever cash flows.
Awesome. Perfect. Thank you very much. See you on Wednesday.
Okay, take care.
Thank you, Professor. Have a good day.
You too, take care.